Idiosyncratic. I mean, Jamie Dimon himself, there are only so many banks that were offsides this way. There may be another smaller one, but this pretty much resolves them all, he said. This part of the crisis is over. So some reassuring words, I suppose you could say, from Dimon on the idea of, OK, now we're going to see just one after another, and that's going to be an anvil around the neck of this market. OK, maybe not.
Maybe not. It was interesting. Josh and I were having this argument when we were on last week, and Josh was saying something like, I think there's more to go. Immediately in the aftermath of SVB, I saw some really fascinating data that showed all the regional banks and what percents of their investment portfolios were held to maturity and available for sale. And you saw how truly idiosyncratic SVB and First Republic were. So right after that, I got much more comfortable with the idea that this was contained to a few banks that had made some really bad decisions. So I'm feeling okay right now. I look at it the way Joe does, I think, which is to say, hey, we know what the Fed's doing, and that's almost over. We've been through a really scary event, and we got through it. We're getting through earnings, and earnings are better than they expect. But here's where I bump into a wall. Where I bump into a wall is the following, which is, if everything goes well, really well, we can get to maybe $240 of earnings, right? What's the right multiple?
Well, see, I was thinking of that, too, when you were talking. I was like, OK, I know where she's going. The valuation wall.
Right.
As I wrote down those words as you were talking, because that's essentially the wall.
Right. And so I can put this really rosy scenario together, but then if you put 18 times on that, all you get to is 43.50 on the S&P. It's up 3.5% from here. That's just not that inspiring.
I don't know. Maybe Jim's going to give you the reason why
we should get past
you can
it?
break through the wall, right? That the wall isn't so high to get over, right? I mean, that's your whole case.
Everybody kind of knows what I'm going to say. You know it. Joe knows it. Jenny knows it.
Jimmy's the sledgehammer.
Oh, thanks, but that's not what it is. It's that you got to look at the individual stocks and the individual sectors. And I would agree with you that, what's led the market this year has been the NASDAQ. It's been FANG. Hasn't even been all of tech. It's been FANG that's led the market. I mean, NASDAQ's up something like 20%. The S&P 500 is up 9%. But if you look at this earnings season so far, halfway through it, the biggest earnings beats and the most frequent earnings beats within sectors have come from industrials, basic materials, energies. Compared to the S&P 500 overall, technology has actually come in less frequent as earnings beats within its sectors and with smaller beats. Now, what's happened here, as I said, FANG has taken off with this market. But where the opportunity lies, and Jenny, this is to answer your question, is the valuations and the earnings growth outside of tech, outside of FANG, are really attractive, really attractive.
So, Weiss, it just, do you continue to go with the mega caps? Or do you take what Jim says and say, you know what, there are other attractive parts of this market that maybe now you lean into if you don't think things are going to be as bad as some thought they would be?
Well, I'm not so sure things won't be as bad as others think they would be. Look, if you take out Amazon, the fact is that S&P earnings are basically flat for this quarter. And sure, you've had 80% of companies beat, but you've had earnings cuts over the last 5 quarters. And when you're talking about 79% of companies beat, typically you're not far from that level regardless of the economic environment because companies manage expectations. So the way I look at it, look, spending time with a lot of people here, including CEOs of some of the largest companies in the world, these aren't people that are reading tea leaves, trying to understand which way the economy's going. They are laying out the tea leaves. They're making the tea leaves. So I continue to be bearish. Now, where am I wrong? Where could I be wrong? Well, I could be wrong in the fact that maybe it's a new generation of investors who's so used to V-shaped recoveries and free money, they're just looking at a new pricing or new valuation paradigm, and that's very plausible. I don't say that belittling them. I say that may be the landscape going forward. So unquestionably, the economy is weakening. We still haven't felt anywhere near the full impact of the Fed tightening cycle, and that is yet to come. So I'm comfortable taking selective bets like in the healthcare stocks or in tech. Did I miss Microsoft? Absolutely. Can it keep going? Actually, I think it can. Meta as well, because yes, Scott, the answer to your question is you keep going with the mega caps because there's safety, there's cash flow, there's balance sheet, and there's efficiencies coming on.